statistically, emerging fund managers just do better. Overall, their median average returns are always superior to their more developed peers in every single asset class. Look, they've got a lot on the line here. If they don't perform well on fund 1 or fund 2, like, they're done. GP stakes is interest in general partnership companies or management companies of funds. There's two main management companies of funds. There's the general partnership, GP, and then there's the investment management company that oversee and manage a fund. That fund is a pool of money that goes out and deploys into the alternative asset landscape, right? They go out and buy real estate, or they invest in other companies. They invest in early companies. They trade on the stock market. If you have an investment strategy where you can take $1, invest it in, make $2, I mean, that's the early makings of a fund in a lot of ways. And so there's all these asset managers out there that are managing and operating these funds. And so we've been working with fund managers for the past 4 years. We identified an opportunity to partner and invest in these early stage management companies and acquire interest in their funds and essentially partner and invest alongside them. I could go out and I could buy businesses, or I could invest in real estate, but at the end of the day, it's, you know, when you're starting a fund, you need to look at, hey, what's the opportunity set you have in front of you, and what is your skill set. 4 years ago, we started an education and consulting company helping incubate first-time fund managers. So I basically consulting emerging fund managers for the past 4 years. We've incubated hundreds of funds through that business. I've worked with hundreds of emerging fund managers, and I've been asked. I was starting to get asked very regularly, to participate in these funds that we were kind of high-level consulting and educating. They said, Lincoln, I'd love for you to come work with me. Like, could you come be an advisor on this business? And, would you like to come work with me more? And I remember there was a client that came through our program that had asked me about 2 years ago to be an advisor on his firm. And I said, no, we're focused on kind of our business. It wasn't the time, it wasn't the place. And he has since raised and deployed, almost $250 million. And, it was a missed opportunity for sure. And, there's been a number of these emerging fund managers come through our ecosystem that, wanted us to work with them. So look, I have the opportunity set in front of me. I know the biggest pains about emerging funds. I've helped incubate hundreds of them over the past few years. And especially in regards to emerging managers, it was unfolding itself. The opportunity set was there. GP Stakes actually started about 20 years ago. It was really established. One of the earliest notions of it was when Tiger Global, one of the general partners there decided to unwind this, multi-billion-dollar hedge fund. And he had all this money. He was done in the business, but he had all of his employees that wanted to go start their own businesses as well, and their own trading strategies, right? He had some employees that were more bullish on certain sectors, and it was the Tiger funds. And so he went out and he staked all of these different hedge funds. They called them Tiger Cubs. And he said, hey, look, I'll give you an anchor check. I'll give you $5 million or whatever, and I'll help you get your own fund off the ground, but I'm going to take, a share of your management company. And I think those are some of the earliest examples of GP stakes. The industry has since, developed pretty radically though. An investment management company is a very profitable business. You look at like consumer sectors or retail or whatever types of businesses, you might have net margins of 10, maybe 20%, maybe even 30% for a tech business, right? The average net profit of an investment management company is about a 60% net profit margin. They're extremely profitable businesses. People identified that and said, gosh, there's a reason that these fund managers of Carlyle and Ray Dalio or Bridgewater Associates, there's a reason why they're making so much money. It's because running a fund is a really good business model, and it's a very profitable enterprise. GP Stakes came for a variety of reasons where these management companies, sometimes they're in need of additional capital. There's something called GP commit, where investors will put, like if you're raising $100 million, it's expected that you put 1 to 5% of the $100 million into the fund. Those partners are now putting $1 to $5 million of their net worth into fund one, right? And then you typically are starting a new fund or a new product every couple years. And so a lot of fund managers are, while they have a lot of wealth, a lot of times they're pretty illiquid in some regards because all their money is invested into their investment strategies. If they wanted to expand, they needed help on fulfilling their GP commitments. Maybe they're in real estate and they want to expand to private equity. They need to go hire a bunch of people. They need money for that, right? And they need bridge financing between capital calls. Like it's a business that has financial needs all the same. Weirdly enough, even though they're managing hundreds of millions of dollars, the management company still has needs for capital. And that's where GP stakes came about. The larger tail of the industry primarily operates with large funds. So I've had the pleasure of getting to know like the GP stakes team at Blackstone and some of these larger organizations. Goldman, the largest is a company called Blue Owl or Dial Capital. They're certainly the largest GP stakes investor, but there's really not a lot of GP stakes investors at the emerging manager side, right? Those examples I gave, Goldman, Blue Owl, Petershill, like they do GP stakes, except their average check size is almost north of $100 million, meaning that they're acquiring a minority stake for $100 million, meaning that business is managing tens of billions of dollars usually, right? So it's really, GP stakes has really only been around in the more developed side of the industry for the past few decades, and it's been a great business. It's been actually, there's all these statistics that's been one of their best performing asset classes. We have this pipeline and that we built this business of emerging fund managers, and they have capital needs too, but there's almost no GP stakes investors that are willing to work with smaller fund managers for several reasons. They're not going to make as much money because they're smaller funds. They're managing smaller assets. It can be construed as a little more risky because you're working with emerging funds, and really a lot of them just don't have the pipeline. It's hard to identify these nascent early stage fund managers and have a proper pipeline. But we felt like we did, and it was a proper time to capitalize on that. So GPs, they need capital for a variety of reasons. When you're growing, you need it for growth capital, right? Like if you are expanding into new product lines, for example, if you started a hedge fund and you've got a team of hedge fund traders, right? That's great. But maybe your investors are saying, hey, that's great that you have this hedge fund product, but I want exposure to real estate. And I think you're a great investment manager. I'd love, do you have any real estate opportunities? That happens, right? Like where investors start to ask their GPs, like, hey, what other opportunities do you have? It's the natural flow of the business to, once you've kind of mastered one product set, to expand into subsequent products. And so as they go from a hedge fund business to a real estate business, they need to go hire new team members. They need to do a bunch of market research. There's a lot of work to do there. It's a sizable investment to go launch a new arm of your company. If the partners, a lot of the times are pretty illiquid, meaning that they don't have the cash on hand to spend on setting up this real estate business. And that's where a strategic investor, a GP stakes investor, can come in and give them growth capital to essentially grow the business. Another use of funds that GPs need is for their GP commitment. And so what that means is most funds it's expected that you're going to put at least 1 to 5 of your aggregate fundraise into the fund. So if you're raising $100 million, you're expected to put between $1 million and $5 million into that business. And a lot of managers, sometimes they can't scrape it together on fund one, but if they can, great. but hey, look, they're going to go start fund two within the next couple of years, but they put the majority of their net worth into their first fund. They don't have any more money to put into fund two. And so that's where a GP stakes investor can come in and allocate on the commitment side. In the GP stakes industry, the majority of companies, when a GP stakes investor is making an investment into a GP, they are purchasing a stake of the company, full stop. So they are acquiring minority interest, and some people are starting to do majority, but typically minority interest in these general partnerships. I love the question when people ask me, why emerging fund managers? There are so many reasons that are actually to the benefit of an emerging fund manager. First and foremost, statistically, emerging fund managers just do better. Yeah, there's a little more standard deviation in their performance returns, but overall their median average returns are always superior to their more developed peers in every single asset class. Now, there's a couple reasons for that. First and foremost, it's easier to compound smaller dollars than it is larger dollars, right? A 10% return on $10 million is generating $1 million, right? A 10% return on $100 billion is $10 billion. The scale at which you have to invest, it gets so much harder to compound investments and to generate high returns in the bigger markets. But in smaller markets, they're extremely inefficient. There's not as many players, and it's smaller uses of capital. So it's a lot easier for emerging fund managers to generate alpha. I also like emerging fund managers because they are coming right out of industry, right? Most of these guys are bringing some unique perspective. They've either been syndicating deals themselves, they've been a broker, they've been working at another big firm, and they've got new ideas. They've got innovative approaches on a somewhat stagnant industry, and they always have extremely creative ideas and approaches about their investment philosophy to increase alpha on a risk-adjusted basis. And then honestly, I like them too because there's more on the line. Mind you, these aren't first-time investors, right? These guys they've invested their own money, they've partnered, they've done deals before, but they're not first time. It's not like they're making investments for the first time, but this is their first time that they're taking on a large sum of money from external capital, and they're managing a blind pool vehicle, right? A commingled fund. And there's a lot of responsibility with that. Look, they've got a lot on the line here. If they don't perform well on fund one or fund two, they're done. Right? Investors aren't going to invest with them. So you've really only got so there's so much more at stake for these emerging GPs that, they have to succeed, they will do everything. They're entrepreneurs, right? In a lot of ways, starting a fund is very similar to starting a business. They have to have some of those entrepreneurial characteristics, to be successful. So, and look, I could keep going, but let me just add one last thing of why I like emerging fund managers. I like it because there's a better alignment of interest. So a smaller fund manager, if you're managing 10 million, and you have a 2% management fee, that's $200K of income. That's going to pay your partners and maybe an assistant. I mean, there's not a lot of extra capital there, right? But if you're managing $1 billion, your 2% management fee, that's $20 million, right? You don't need $20 million to run an investment management business. You just don't. That's absurd. Because there's two primary ways that a fund makes money, right? There's the 2% management fee and there's the 20% performance fee. What happens is at these larger funds, I mean, these bigger guys, they can kick back and they're still going to make $20 million, right? And they're still going to have, a great business regardless of their performance. A smaller fund manager, they are barely paying the bills, right? And they really only make money when they perform and they get to participate on the carry of that 20% performance fee. I think the bigger players don't tend to support emerging fund managers just because it's a riskier investment. They are going to have to spend a lot of time for a relatively lower payout at the nascent stages of the industry. Really, the structured industry of GP stakes has only been around like a decade. And that's new in finance terms. That is extremely new of a kind of investment strategy. So, I won't be surprised that within the next few years, there's an abundance of GP stakes firm that cater to an emerging manager. I just don't think that the market has developed yet, and it starts that way in all industries, right? When you looked at leveraged buyouts, they started with some of the largest leveraged buyouts in history happened closer to inception of that kind of investment strategy. And the same is happening for GP stakes because it's the highest payout. Sure, you can go make 10% on a $10 million deal or a 10% on a $100 billion deal. Like, they're going to always take the larger deal because there's a bigger payout there. So as the industry matures and kind of gets its feet underneath itself, I won't be surprised within the next couple of years to see a number of GP stakes firm that focus on emerging fund managers.